Howdy there, folks, and welcome into today's video. We got a good one here today to react to. Just one video. Google has a big problem. This is an amazing video Joseph Carlson just put out on one of his channels, and I want to go ahead and react to the first half of this video with you guys because the points he brings out are absolutely phenomenal. And Google is a stock that I think a lot of us are either buying or starting to buy or thinking about buying in 2023, right? Along with a lot of these big tech stocks that have fallen immensely. And I mean, you look at Google, Meta, Amazon, Adobe, Shopify. I mean, you could just run through, and just the amount of stocks that have fallen 30, 40, 50, 60, 70% is a pretty long list, right? And so when we're thinking about this, right, we've got to consider many various factors. And one of those is in relation to what Joseph brings up as some points in this video that I want to react to, give my opinion on, and share some thoughts on, because this is a good one. So hope you guys enjoyed. As always, I appreciate everybody that subscribed to the channel. I think we're approaching 19,500 subscribers, something like that at this point in time. So thank you very much, everybody that subscribed to the channel. Let's go ahead and watch this.
On this episode, I have a little story to tell. A couple days ago, I threw out a tweet. I tweeted something on Twitter like I frequently do. You can follow me on Twitter if you haven't already. But this tweet was something special. This one went viral. It got thousands and thousands of likes, hundreds of retweets, hundreds of quote tweets. It had hundreds of comments. It really went nuts. It got passed all across Twitter. This is one of the most popular tweets I've ever had in the history of my account. Let's go ahead and look at it. This is it. In the tweet, I outline that Texas Roadhouse has outperformed Google over the past 10 years. Texas Roadhouse has outperformed Google over the past 10 years. And I also show this graphic here showing the performance of the two companies. They're pretty close for most of it. They match each other somewhat, but then Texas Roadhouse ekes out the victory over the past decade. Now, again, this tweet went nuts. Let's look at some of the numbers here. It got 7,686 likes so far, and every hour it's getting 100 more likes. 149 quote tweets is a lot of people interacting with it, and 455 retweets. A lot of people enjoyed seeing this tweet, or they thought it was interesting, or they thought it was baffling. And when I looked at this, I thought, why did so many people interact with this? Why was this such an interesting piece of data that people wanted to share?
So I think this is extremely important for everybody watching this video right now to understand this, okay? And where my mind went, and Joseph doesn't talk about this, but where my mind went when I saw that is it shows you that unbelievable performing stocks can come from anywhere in the market. And, a lot of people don't even know, like Monster Beverage was one of the best performing stocks over the past 20, 25 years. And you can get some random companies that don't have super complicated business models, but perform absolutely amazing and actually significantly outperform even the best of best companies that people would think are the best, right? So that's kind of where my mind went here, but Joseph's about to dive in here pretty deep, and I love this.
And I think there's a couple reasons why. First of all, Google is a world-class tech company, the best of breed. It has arguably the best business in existence ever, all time in any company ever created on planet Earth, the best business ever. It's arguable that Google search is literally the best business ever created in the history of mankind, and Google owns it. That's their core product. That's where they get most of their revenues from. Google doesn't only own Google Search, they also own YouTube. They purchased it for a small price, and it's grown substantially to become the biggest video media platform on Earth. It's arguably the best social media platform. Marcus Brownlee says it's the only S-tier social media platform. YouTube has been a wild success, now generating immense profits. Google owns Android, a money printing machine where they collect fees through their app store, where they have access to half the world's phones. So what we have here is a world-class tech company, the best of its kind that owns properties that are unparalleled. It has a wide economic moat, and yet it's being outperformed by a steakhouse, a restaurant, a company where you walk in, you sit...
Hey. Texas Roadhouse is not just a steakhouse, okay? It's amazing. It's flipping flapjack and amazing. I mean, can't beat it.
And there's a server that comes and asks you what you want to eat. And their big invention, the big thing that they do is give you yummy food on a plate. Steaks, something that's existed for 1 billion years and something that has intense competition. Restaurants are arguably considered to be not one of the best industries, not one of the best businesses, but arguably one of the worst. Peter Thiel says that restaurants are the worst industry because of the commodity of the product and the incredible amounts of competition. They face fierce competition. So we have a commoditized product, a steakhouse, versus a world-class tech company with the best business model ever created, which is Google search, and we have the steakhouse winning. That's why I think this tweet went so viral. How does this type of thing happen? How does Google lose out to Texas Roadhouse? You might argue it's because of valuation. Maybe Texas Roadhouse just had a massive PE expansion. Nope, that wasn't the case. They both have maintained around the same valuation and the same multiples throughout their growth. You might argue that I'm just being selective in my timeline, that the 10-year time horizon isn't the full picture. And if you zoom into the last 5 years, that Google's outperformed. That wouldn't be accurate either. Over the past 5 years, for example, Google has given an 84% return. Over the past 5 years, Texas Roadhouse has given a 101% return. And that's not counting dividends. So the outperformance over the past 5 years is even greater from Texas Roadhouse. We can even look at the past 2 years. Google has given a 10% return in the past 2 years, and Texas Roadhouse has given a 29% return over the past 2 years, not counting dividends. So I'm not cherry picking timelines. Texas Roadhouse has been outperforming Google over the past decade for all the various timelines. And the big question is, why is this happening? How does this type of thing happen where the superior company is losing to the far inferior company? Google is objectively a better business. It has better assets, a better moat. It has the Google search business, and it's being outplayed by Texas.
I think something that a lot of folks get confused sometimes in the market is they look at like, well, this company's like a giant corporation, so it makes it better, or the stock's going to perform better because like everybody uses this product. And it doesn't really work like that in the market. It's all about what the company's currently trading at, what its market capitalization is, and where the company's revenues and net income are going over the coming years, right? And what you can justify as a valuation for that particular company. So, but I see that as like a common thread out there many times that people are like, no one ever heard of this company or that company or this company. And it's like, this one's way bigger. And it's like, just because it's bigger doesn't mean it's going to make you more money. That's just not the way this whole game works. I mean, you could have looked at, GM and said, well, GM's way bigger than Tesla, so GM's going to be a better. It's like, that's not how this works, man. So I appreciate that.
House. In this video, we're going to go over the reasons why. I'm going to go over and give the argument and what I think is behind the superior performance of an inferior company. Now, I think the first thing that we should look at when we're trying to find out why Texas Roadhouse is beating Google,
we call it an inferior company, maybe inferior business model.
Should not only look at the stock price, but we should look at the operating performance of the company. To do that, we're going to be using Qualtrim Insights, which is a stock analysis tool that's available as part of the Patreon membership. So you can try it out with a free trial. Now, if we look at this, we can bring up Texas Roadhouse's free cash flow. This is really what generates the returns for companies long term, their cash flows. And Texas Roadhouse has been very effective at growing their free cash flows. They grew their free cash flow at a 17% compound annual growth rate for the past 10 years. So 17%. That is very impressive. Anytime a management team can do that for 10 years straight, that is a very impressive thing. So hats off to Texas Roadhouse. They're doing a very good job. Now we compare that to Google, and Google's performance is actually superior. They grew theirs at a 19.67%. So Google actually grew their free cash flows at a faster pace, a little bit faster every single year. Why is Google's not matching Texas Roadhouse's? The first problem, I believe, is that Google has to dilute you to grow these free cash flows. Texas Roadhouse does not. For example, we look at the stock-based compensation here. And even though Google's growing their free cash flows at a higher rate than Texas Roadhouse, notice the amount of stock-based compensation they also have to do over this time period. Now, stock-based compensation isn't technically part of free cash flow, but when a company dilutes you, you own less of the cash flows. So it is a big factor. And what we look at is that around 25% to around a third of the free cash flows of Google are also being diluted away with their continual dilution for stock-based compensation.
That's a massive amount. And I think this is extremely important for everybody watching this to understand is, a lot of people think about dilution of shareholder value, and they think about just like, a company that needs to raise capital. So therefore they got to dilute that way. But also there's extremely healthy business models like a Google McDougal here, right? Where they're basically just flooding shares out there in the market, giving them to employees, right? And so you're constantly getting diluted as a shareholder of the company by new employees that are essentially coming in. And it's very common in the tech field to do this, but we have to admit that it destroys a good portion of the, of shareholder value. That's what it's doing essentially.
Grew their free cash flows at a 19.6% compound annual growth rate, and then they grew their dilution at 22% per year. So both of these are going up over time, but the amount of dilution is actually outpacing their free cash flow growth. Now, when we compare this to Texas Roadhouse and look at the amount of stock-based compensation and dilution this company has to do, it's very minimal. They have grown the amount of executive compensation over time, but in this case, Texas Roadhouse's dilution is growing at a slower rate than their free cash flow. They've grown their amount of stock-based compensation by 13.7% over the past 10 years, and they've grown their free cash flows at 17%. And overall, you can see right here that the dilution makes up a very small proportion of their free cash flows. So another way of saying this is even though Texas Roadhouse has grown their free cash flows at a slower pace, those free cash flows are more meaningful because they're not diluting the shareholder. You actually own the majority of those free cash flows. Whereas Google's growing their free cash flows slightly faster than Texas Roadhouse, but because of the dilution, the amount that's eating up of those free cash flows don't have as big of an impact as they do with Texas Roadhouse. Now, here's the interesting...
And I think another way of putting that is a Texas Roadhouse new employee comes in and is like, oh, awesome, I'm going to make $15 an hour, right? Or I'm going to make a certain amount and I'm going to get my tips if I'm a waiter or waitress or whatnot, right? Whereas an average Google employee comes in and says, what's my salary? 200,000? Not enough. I need 300,000. Oh, I also want a lot of stock-based compensation as well. So it's a very different, let's call it workforce, in the expectations that are going in for both those workforces, right? And Google's usually going to get the most, it might sound as a negative term, and I don't mean it to be negative, but the most entitled employees you can possibly find, right? They're going to want the absolute top dollar, and they're going to want the absolute most stock-based compensation they can pretty much get their hands on, right? Or they're going to walk out and go somewhere else. Whereas a Texas Roadhouse employee is like, I'm looking for a job. This is awesome.
Google's a tech company. They're the company with code. Code is supposed to be scalable. Scalable is a very attractive thing in investing. It means that when you reach a certain scale, your costs are fixed, but your profits continue to go up. That's scalability. That's also called operating leverage, meaning that once you get to a certain size, the amount of increase in revenue leads to outsized profits because revenue goes up, but expenses do not go up. So the margin there is substantial profits. That is scalability. That is operating leverage. And that's what tech companies in particular are supposed to have because tech companies run off of code. Code is something that's easily replicable. It's something highly scalable. I can write one line of code, and it doesn't matter if 10,000 people use it or 100,000 people or 100 million people. The one line of code works the same way. That is the inherent scalability of technology. This is such an important aspect of investing, and this is such an important thing in technology in general that there's big influencers and big thinkers like Naval Ravikant that say that you should focus on companies that have this inherent attribute of scalability. Here he is talking about the zero marginal cost of reproduction for code.
But technology products especially and media products have this great quality where they have zero marginal cost of reproduction. So creating another copy of what you just created is free. So when somebody listens to this podcast or watches a YouTube video about this, it doesn't cost me anything for the next person who shows up. Those zero marginal cost things, they take a while to get going because you make very little money per user, but over time they can really, really add up. So Joe Rogan is working no harder on his current podcast than he was on podcast number 1. But on podcast number 1100, he's making $1 million for the podcast, whereas for the previous one, he probably lost money for the first one.
That's right. That's scalability. That's operating leverage. It means that you're doing the same thing that you've always done, but because you have a bigger audience or because you have more users, the amount of revenue outscales the expenses. And that outscaling of expenses leads to margins. That is operating leverage. That's what Google's supposed to have a lot of inherent in their business. But what we are seeing in the math and in the numbers is something different. It's almost as though Google's not scalable at all. It's almost as though the company has no operating leverage. There's something wrong with this picture. In fact, we can dive into this even further, and I can throw up the expenses of the two different companies, and we can see which one is scaling with their expenses better. We have the top one here, and then we have the bottom one here. Now, I'm not going to show the names of them, so you can try to pick out. If you were just looking at these expenses and the growth of them over time, which company looks like it's scaling better? If the revenue is growing for both of these companies at an equal pace, which company is keeping its expenses more in line, not growing its expenses over time? Is it this one up here or this one down here? I think it's pretty obvious. The one down here is. It's more level for the past 10 years. That is Texas Roadhouse. Google's the one that looks like it's not scaling at all. The expenses go up every single quarter of every single year. There's no operating leverage. There's no scalability. And this is a problem. When a tech company is getting outscaled by a restaurant, that is a problem. That is something that I think is worth looking into. Part of the reason that I invested in Google and many other companies centered around code is the inherent scalability of code. Take Qualtrim, for example. I've worked on this with 2 highly skilled developers. We built out the application, and at first it only had a couple hundred users. Not many users and a lot of work. But then over time, it's grown to where it has now 2,700 users, and it continues to grow in its usage. The growth in usage has not caused us to do anything different. There's no extra work because another 100 people start using it. The only added expense is a tiny amount of server cost. So it has inherent scalability. That's what...
So to put this most simple way as possible, right? You know, you look at a business model like Texas Roadhouse, right? And I'm always like, oh, I wish there was a Texas Roadhouse closer to us. Why is one 30 minutes across town? Like, we got to go all the way over there, right? And so the only way Texas Roadhouse could ever get me as a customer, you know, to be a regular customer, I guess you'd say, not like I want to drive 30 minutes to go over there, is if they built one closer to me, right? Versus, obviously, if you're an online business, an app, a website, whatever it is like that, right? Metaverse in the future. You have like I don't want to say the whole world's at your disposal, but obviously at least the United States of America, if you're in the United States of America, right? And folks could find you all over, and that's how these things can grow from basically no user base to all of a sudden 1 million and 10 million, 100 million, 1 billion, right? Is because it's so accessible. You don't have to like, oh, I need to go build a physical restaurant and like do this and hire these employees. It's like it can just spread around pretty much the entire globe, which is busy. You know, it's beautiful when it comes to these big tech companies. It's a beautiful thing, but at the same time, we're finding some flaws, obviously, in the business model, right?
Code is supposed to have. That's what media is supposed to have. And with Google, it's like we're not seeing that. I've been raising these concerns for a while. This was around 3 months ago. I highlighted that Google has an issue with hiring more and more employees. They're hiring so many employees that it's almost inconceivable about what all of them are doing. They're not launching new products. Google's not coming out with a lot of new stuff, but they have more and more employees every single day. Another 500 new employees a day added to their company. Listen to this clip. This is from 3 months ago, going over Google's earnings report, their own. All these companies will continue to grow their cloud efforts, but I believe that it will continue to be a very top-heavy industry. Now, one thing that I don't like to see in Google's report, and I actually thought that this was weird and somewhat concerning, is the massive amounts of employees the company's hiring. Year over year, they went from 144,000 employees to 174,000 employees. So they increased the employee headcount by 20.8%, which is an additional 30,000, above 30,000 employees year over year. They increased employee count at a faster rate than their revenue growth and their income growth. They're growing employees faster and faster. And this is a tech...
Let me just call it how it is, okay? Silicon Valley for the last, especially the past like 3 to 5 years, has been in war with each other. Google, Apple, Meta, all these companies, they're in a war with each other. And the war they've been fighting for the past 3 to 5 years, that is ending now at this point in time, has been, let's try to hire as many workers as possible to keep them away from the competition or future competition. That's been their whole goal. So they've been like adding this war chest of employees, and let's just add employees, and they could justify it to shareholders on, we're trying to find growth opportunities for the business. That's how they could justify it, right? But when you look at these companies, you really start to understand what are these employees really doing, right? And you look at a company like Google, and it's like, they're still, when you, and I went through their income statement on either this channel or the main channel a few days ago. I think it was a few days ago, maybe when I compared them versus Meta versus Amazon. Like, what you're going to find is that almost all their money still comes from Google search, YouTube, and obviously Android, like and the other cloud business, right? So from these businesses that have been around for quite some time, and there's really nothing else there that it's like, wow, this is a massive growth vector for the company. If you look at a company like Apple, they're still running off, everything that Steve Jobs set up in that company, right? Their whole business model is everything that Steve Jobs set up, and he's been gone for over a decade now, right? And so it's like, what do they have to show for? Making the iPhone a little bit better each year, making the iPad a little bit better each year, making the MacBook a little bit. The whole business model was set up from Steve Jobs. So what's the next transformational thing that Apple's even doing that they're spending all this money on? Like, that's something to think about, right? Meta, Facebook's been around a long time, right? Obviously they bought Instagram, they bought WhatsApp, but what's been so game changing with Meta over the years? I mean, the most game changing things I could possibly think of, to be honest, right? That's a stock I own a lot of, and I'm going to buy a lot more, but I got to admit it, it's not like they've done anything that's like, wow, can you believe this? Instagram stories was big, right? When they added stories, but they just took that from Snapchat. And now Instagram Reels is taken off in a massive way, but they just copied that from TikTok essentially. And that's like the biggest things they've done with their business model, right? Over the last number of years. And obviously they're trying to do metaverse, but we still get to see if that's going to be a success. So I think a lot of these companies have a lot of questions. It's like, you guys are adding ridiculous amounts of employees over the last number of years. And where are these game-changing new products and services? Where are they? And none of them have anything to show for it. Anything.
It's supposed to scale. It's supposed to be efficient. Why are they hiring 30,000 employees in 1 year? And I know what a lot of people are saying when they listen to this. Oh, Joseph, those employees are good assets. They'll help out the company. They'll help it grow. They'll build new things. That's good in theory. Maybe they will do that. But I have a hard time believing that they need this many employees. I think some of these hires are very unnecessary. And to investors, this is important to note. This is important to pay attention to because employees are paid partially. A good part of their compensation is stock-based compensation. With the huge majority of those, that's what I highlighted over 3 months ago. Google is becoming unscalable, the opposite of scalability. Their employee count and the amount that they're paying in expenses is rising faster than their actual operating income, their free cash flows, and their revenue. They're being outpaced by their expenses. So not only is Texas Roadhouse outscaling Google, doing that without even being in the business of code, but not only are they doing that, Google's becoming unscalable. I don't even know the word for it. They're actually having their expenses rise faster than their actual income. So I've been raising this concern for a while. I've been pointing out how
So, and if you want to check out the other half of that video, you can check out Joseph's channel there. I think, how do I see this playing out? I think Google's going to likely have big cuts coming. Now, Google's going to be able to go one of two ways, and it seems like Wall Street's almost giving them an option here. It's either they can voluntarily make a cut of 10,000 or 30,000 employees, or Wall Street will send the stock down in a massive way, and it will be covered everywhere, and everybody will talk about how much Google stock down. They're going to do what they did to Meta. And Meta held on for the longest time. And then Meta finally cut after that last massive drop for Meta, where it dropped under $100 a share, right? And even under $90 a share. I think it fell to the 80s, if I recall, right? And that was the straw that broke the camel's back. Is that the saying, right? That they were like, okay, we'll do what you guys want us to do. We'll cut 11,000 employees, right? And so Google has an option here. They can let Wall Street make them do this, or they can do it themselves. But it's likely going to be one of those two scenarios because they are likely way overstaffed right now, and they have tried to not cut. Mainly, in my opinion, because their stock has been hit, but it hasn't been hit so insane that it makes everybody look like, what are you guys doing here? And so, yeah, we'll see how all that plays out. But I think, if anything, I wouldn't be surprised if Google starts to bring down expenses in a major way and has revenue outpace expenses over the next few years because they're way overhired. They're way overstaffed. And I would say that for every tech company right now. I think, like I said, they've been in a war with each other, and I think they're all realizing it right now. The problem with Google is they should have done the cut. They should have done the cut a few weeks ago. When Meta announced a cut, Amazon announced a cut, that's when Google should have cut. Now Google's in a weird position. Do you want to announce a cut in the middle of holiday season? And then if you wait till the first quarter, that's not going to look good, because let's say they wait till January, then everybody's going to assume that the quarterly numbers are going to be trash. That's why they're cutting employees, right? So no matter what, now it seems like Google's going to have a much uglier situation on their hands, stock price wise, and what could potentially go on there, which even gives myself concern about, if I'm going to allocate capital out there, do I want to allocate a bunch of capital in Google that could have more bad news coming, or do I want to allocate it in Meta and Amazon that have already gone through the gauntlet of bad news? So that's something I'm considering as well, right? And I think we all have to consider as you kind of build out positions and those sorts of things. So appreciate you guys joining me as always. I think we're approaching 19,500 subscribers now at this point in time. So thank you everybody that subscribed to the channel. Appreciate you guys. Also, our massive once-a-year sales coming up for the Black Friday sale. If you want to basically receive an email with a deal as soon as it drops on Black Friday, check out the pinned comment down there and we'll send you over the deal for the private Discord chat, all the course curriculums as soon as that deal drops. Much love and have a great day.